right, welcome back to the show, everybody. Today we're going to discuss the reports and data that you should be looking out for that influence your life. Chris and I talk about a lot of these reports throughout every single episode, and we figured why don't we just put them all together into one to make sure that you're paying attention to these as they come out.
So in other words, all the stuff we talk about pretty frequently, it all comes from some of the data we're going to talk about today, but there are certain high point pieces of information that we routinely follow, that the Fed follows, and other people that are really making kind of critical decisions follow too. But we thought if we laid these out for you, and then obviously gave you some pretty good examples of some data that just came out when we get into my section, the sexier section, if you will, that perhaps you will understand why they're relevant and why we lean on them so hard.
Yeah, you'll be able to anticipate things that are going to be happening in the future, and you'll be able to
see the future?
You can see the future. I mean, we haven't been wrong yet. And you'll be able to make a more informed financial decision.
I get a lot of people in the DMs recently. I don't know why. In the last couple of weeks, I'm getting a lot more people sending us messages saying, hey, the economy is heading the direction you guys have been saying. You were right. You called it. And it's weird because I know that we've called a pretty dark kind of end to this financial cycle.
Yeah.
And people are starting to feel that way. So I've got really mixed emotions about it.
What GIF are you replying back with?
What GIF am I replying back with?
Is it GIF or GIF?
It's GIF. You say GIF because you're weird.
I do say GIF.
Yeah. Us normal humans, Haroon and I, we say GIF.
Why? Because if you just add a T, then it's gift? Is that why?
No, it's spelled GIF.
Yeah.
Okay, Haroon, you want to do the ABCs with him again?
So how do you spell giraffe?
Okay.
One
anomalous word.
One anomalous.
So do you call it a gift?
No.
You say gift.
All right.
Is it more like giraffe or is it more like gift?
Exactly. So the first report that we're going to talk about, which actually was revised recently, is the GDP report, right? The gross domestic product report. This gets actually published monthly but the one that's official by the Bureau of Labor Statistics, that comes out quarterly, right? And this report is a broad stroke of the economy to give you a sense of how healthy the economy is doing. The last report that came out for Q1 of this year came in at a positive growth of 1.6%, which would be pointing to signs that we're in a very healthy place. I mean, everyone should be doing very well. But then it was actually revised down to 1.3%. And you're like, hold on, what's going on here? The Fed has been holding rates higher for longer, and we're still experiencing positive growth after this long when they've been actively trying to slow down the economy?
Yeah. So I think there's some good points to hit with GDP. The world tends to complicate it. Gross domestic product just sounds like one of those words and phrases that you're like, gross domestic product? Is it this big macro? Doesn't matter, okay? Let me break it down to you real simple, okay? If people are spending more money, gross domestic product goes up. People are spending less money, gross domestic product goes down or can go negative, right? Growing positive GDP means the economy is growing. Negative GDP means the economy is shrinking. And for all intents and purposes, if you have 2 quarters of shrinking GDP, a shrinking economy, meaning 2 negative numbers, that means you have a trend of the economy shrinking for 6 months, which is generally the well-understood definition of a recessionary economy.
Right.
That is the reason why GDP is so important. Are we growing? Are we growing at a sustainable cadence? Are we shrinking? Are we shrinking over time for more than 3 months? You can have 1 quarter of shrinking and then another quarter of growth and, okay, you're not in a recession, you just had a bad month. But when you start seeing the trends of 2 quarters, that's generally the recessionary kind of beginning. And generally speaking, some food for thought, gross domestic product growing at an accelerated cadence too fast can be very, very bad for the economy because guess what doesn't grow fast? Wages. Right? So if we're all spending a ton of money and the economy is just growing massively, but wages aren't going up, where is that money coming from? It generally is coming from credit and from debt. And it's generally going to backfire in a shrinking GDP, a trailing quarter. But we haven't seen that for a prolonged period of time. We'll get into GDP a little bit more later in the show and a little bit more about how it impacts things like the Fed decision.
Right. So under a normal set of circumstances, the Fed would be actively trying to hit a number like 1.3%. That'd be a good number for them to hit for positive GDP growth. But for what the Fed has been trying to accomplish by taming inflation, that is definitely a little bit too high for their liking. So the next report that we like to stay locked in on and tune into every month, first Friday of every single month, is the jobs report.
Hold my beer.
Yeah, which if you've been listening to us for some time now, you know that we take great exception to some of the numbers that get reported. The jobs report basically gets printed and lets you know how many jobs are being added in the public space every month. And some of those numbers are estimates, but in that you'll also get, wage growth, right? You'll get average hours worked, and you'll also get the big number is the unemployment number.
So there are different sources of information which really report on jobs numbers. You have the private employment numbers, right? So companies will report to people like ADP, who report back to the community in the world what they're seeing. But the Bureau of Labor Statistics reports the unemployment numbers. And those are the numbers that you typically see. But you could be saying, well, Chris, wait a minute. There's revisions down in GDP. There's revisions down in unemployment. Yeah, because as data comes in, as they validate more of this data over time, they get more and more data to look at, and they can, further narrow down some of the assumptions they made in getting these reports out on a pretty consistent cadence. I know that sounds weird, but suffice it to say, lagging indicators, lagging data that comes in has multiple sources that come in, and sometimes they got to assume some of the sources that are coming in are going to hit approximate numbers, and when those numbers come in, they may not line up, so they have to revise numbers up or down, or in some cases, rare cases, they keep them the same. While this concept is generally understood, it's really, really important for employment data as of late, because what we've seen is a pattern in practice of these healthy employment numbers coming out and consistent revisions downward, corrections downward that aren't being reported and picked up in major media.
Absolutely. And actually, we're going to get into this report later on in the show. But what's going to be telling and what we're actually going to get into is there's a true misunderstanding right now with how healthy the labor market is and how this data is being represented. And we'll stay tuned into the rest of the show and we'll get into it. The next set of reports that we like to look at, and not only us, but the Fed likes to look at, and those investors in the stock market like to look at, right? Because it really impacts what the Fed's going to do, is inflation reports. That's no secret, right? We always talk about it. We talk about CPI, the Consumer Price Index, or PCE, right? Personal Consumption Expenditures.
Yep.
And I believe with that also gets tied in PPI. There's a Producer Price Index. That's more for businesses and what wholesalers are paying. So if you want to look into those numbers, because if their prices are going up, or if that number is going up, then that extra cost that the wholesalers or businesses are paying will get passed on to the consumer. Now, the PCE report is the main one that the Fed routinely cites, and they like to look at core inflation there, where they remove food and energy, and but they also like to look at CPI.
For a guy who constantly tells me I need to slow things down and clean it up, that was some high level shit.
That was high level.
Oh yeah, you just Haroon, that was a lot, right?
He did very well.
Yeah, that was.
He didn't even read anything all off the top of his head.
Yeah, that was all.
That's what happens when you prep.
We did,
my guy.
We did. We've been talking about those reports for 2 years. So if I don't got that part down, then we got some problems.
I was thinking about making a joke again, taking a shot across the bow at a room, but I'm gonna be a bigger person.
You're not a bigger person though.
Come on, bring it.
No.
So
I love you. I don't.
You didn't see what I did. Double entendre there.
No, I got
you.
It.
Oh, you were being a bigger person by not accepting it again.
Yeah,
wow.
Again, I'm being an equally larger person by not accepting the acknowledgement of said joke about his weight, which is immature and inappropriate.
That's really. That's not what I said.
That's what you said.
That's not what I said.
All
right.
Chris is very mature.
I am extremely mature. I like the record to show.
All right. The next set of reports.
No, not done.
Okay, my bad.
Inflation, okay, is probably the most important thing you're going to see in the media reported on consistently. Ironically, as Saied alluded to, PCE is probably a bigger focus in some ways for the Fed, but they like to look at core inflation. Now, we're going to talk about inflation and core inflation and the importance of the Fed decisioning coming up a little bit later on the show. But today is June 11th that we record this.
Big day tomorrow.
Yes, the Fed FOMC meeting for June is taking place. The first day was today. Tomorrow is the second day at which there will be a press conference and they will announce their decision, which is largely believed to be a holding of rates.
I mean, largely is an understatement. It's a 99% chance.
Yeah, it's extremely high at this point in time. That being said, we have an interesting conundrum that has fallen upon us, which doesn't always happen. The inflation data is actually coming out the same day, just a few hours before the Fed press conference.
Which you already know the Fed is being privy to beforehand, right?
We assume as much, yes, but there is nothing official saying something to that effect. So the Fed will actually have fresh data and a fresh inflation report. Now, whether that data goes up, which is bad, or down, which is good, or stays the same, it all has implications on the Fed's decisioning, and it'll be interesting to see how that data coming out the same day they have a press conference may or may not impact their decision making.
Right. So another thing that I neglected to mention about these inflation data reports is in these reports, you have components that are broken out, right? In CPI, you have things like food and energy, and then you got shelter, and then you got services, right?
Mm-hmm.
And they're all broken down. They're all weighted differently to create this average. And it's not the same for the PCE report, at least the weighted averages,
Yeah.
right? For instance, in the CPI report, shelter makes up, I believe, 33%, 34%.
Approximately 33%, yeah.
But in the PCE report, and mind you, why I'm talking about shelter is because it has such a huge impact in the overall headline figure, which massively gets reported on. A lot of people only read the headline figure, and that could sway optimism into pessimism one way or the other, depending on what that headline figure is. So the PCE report that the Fed's like, we want to look at that one because that one over there takes shelter into, far less, like, they don't weight it as much. It's around 18%, 15 to 18%, I think.
And to make this very clear, shelter has been the biggest thing we have spoken about on the show for the greater portion of, I think, 2 years now.
Yeah.
Where we have said that just from a mathematical standpoint, to hit the Fed's 2% target rate, it is impossible to get there without a correction in rent and rent equivalent, which all feed into the shelter component. And just today, I don't think I made the show notes with the data. Maybe I did. You guys saw it. Tell me if you saw it. That for the first time ever, we know from a previous show that it's cheaper to rent in all 50 states than it is to buy. But what I thought was stunning was that the cost of homes, the shelter cost and all-in cost of maintenance, because obviously inflation has impacted things like maintaining your home, even for people who have mortgage rates in the 3% range, is higher than it is to rent right now. So even if you have a low rate and you were the benefactor of a low rate and you got in, you were able to buy a home, your total shelter costs are higher than rent right now, even with the low rate.
Absolutely. And I know
that's crazy.
That is crazy. You definitely know homeowners insurance is not helping out at all.
Well, that's one of the biggest contributors to the problem is homeowners insurance. Obviously, in some states, you have tax implications. California has Prop 13. But all of your water, your gas, your utilities, that's all gone up. Your repairs and maintenance is going up because of the cost of your lumber and stuff like that. Or just go to Home Depot, man.
Yeah, I mean, if you got a handyman that you're frequently using, right? Like, his cost of living has gone up, so now he's going to charge you more for some basic work that he probably used to not charge you so much on.
I'm again refraining from making a joke as a reference to handyman.
Well done.
Yeah.
Now, since we were talking about the shelter components of the inflation reports, next up on our list are the housing reports.
Yeah.
That's existing home sales, new home sales. You're talking the permits that they're getting, right?
Mm-hmm.
All of these things will let you know how healthy the housing sector of the economy is.
Or a lack thereof. There is a couple influencers, I will call them, that I follow on certain pages. The Real Deal is one of them that has some influencers that I follow, for example. And there's a number of them that make these over-the-top, ostentatious, in-your-face, bold, hey, the housing market, values are only going up, it's always a good time to buy claims. And I have seen a very palpable and visible change in the rhetoric because you're seeing home prices being cut at a faster cadence than we've seen going all the way back up until, I want to say, like somewhere in mid-2022. So for the first time in approximately 2 years now, you're seeing the fastest decrease in home prices. And I think that's going to continue a trend because, look, again, if the Fed's going to hit that target rate of inflation, you got to see home values and rent equivalent come down. And people who are, I guess, opposed to this like to point at some of the housing reports and data reports that have come out in the past, call it 3 or 6 months. But what we know about housing reports, all of them, is they're essentially lagging indicators.
Yes.
That data comes in and gets corrected. So the same way GDP is revised and can be revised down or up, the same way employment numbers can be revised down or up as more certain data comes in. The most laggy of these lagging indicators are the housing reports.
The laggiest of
The
laggers.
laggiest of lagging indicators. So those are often misrepresenting what you're currently feeling in the market. So if you see a housing report come out on the news and you're like, wait a minute, that doesn't sound like what's going on at all. Sure, you could be in a community that's impacted differently. Yeah, that's a possibility. But in most cases, you're actually feeling what's boots on the ground, and that's really reporting what happened 6 months ago.
Yeah, absolutely. And a lot of times, what you might be seeing is, national averages, like Chris just mentioned. That is, for you to look at these reports and try to figure out what's going on in your community, you got to look at it regionally, right? So it's really interesting though, because if you're looking to buy a home, you would think that if values were going up, that would create more economic optimism. But given the times that we're in right now, and buyers wanting to come into the market,
Yeah.
I think what they're going to want to see is actually prices to come down in order for optimism for housing to get back up again, right?
Well, there is a way. So I've been having this conversation with a lot of people, and I like to poke the bear, particularly on X, where I go to people who are housing pundits, who are really anti the housing market, and just kind of get a different feel for different perspectives. The most contra perspective I've heard about home values going down is, look, in the 1980s, we saw a lot of the same problems that we had today. You also saw them in the 70s. And the housing market took about 20 years to correct. That could absolutely happen. It could be a slow, painful drag on affordability over time. I certainly hope that's not the case. Obviously, there are implications to an entire generation of what would otherwise be homeowners that may not derive their net worth. But the contra to that, the contrary opinion to that is you have to have wages go up, rates come down, and home values come down to get to a reasonable affordability again. And having all three of those things happen at the same time just seems improbable.
Yeah, not very realistic, right? But in order for consumer confidence in this space to continue to rise, I think we're going to need to see a slow, gradual, come down effect on these values.
But housing is one of those things you look at. So when you see the housing reports, you see the data that comes from them, you're looking to see, okay, if housing is showing slower sales means more desperate sellers means lower home values means shelter costs go down, shelter costs means inflation will likely go down. So you can see why one of these reports comes out, the market has this intimate knowledge of how the data feeds into one another and goes, okay, employment starts are low, data showing low, values are probably going to come down. If they come down, that means inflation will come down. We get closer to the Fed's target. There may be a Fed cut in the future. So these are all the logical things that investors and economists are thinking through when they make their predictions, and that's why these reports are important.
Right. We're big fans of Redfin, so we like getting our housing data over from Redfin.
Yeah.
Next, the last two that I decided to throw on here are retail sales report and the manufacturing indices. These now might be a little bit more technical, but they might give a little bit of insight, right, into if you're looking at a retail sales report, it'll give you some insight as to consumer spending. Yeah. Obviously, if consumers are out there spending, right, you think there's more confidence out there, and that probably also means that the stock market might be doing well in those given sectors. But something that you also key point that I think we've all grown to know over the last, give or take 12 to 18 months is that when inflation is higher, right, sometimes what will happen, and actually not even sometimes, a majority of the time, people go out and spend more because they're afraid of prices continuing to go up. So it only affects it more later. When prices start to come down, that's when businesses really start to get hurt, because now consumers might decide to hold on to their money and wait to see for prices to hit their rock bottom. But when inflation is higher, consumers are actually making it worse by going out and spending, trying to buy it now before prices get even higher and higher. We saw this in auto loans.
Yeah,
right?
You did.
Yeah.
So to recap here and be very clear, if I were somebody who wanted to start engaging in this space and really get close to the data, I would look at GDP. I would look at inflation, specifically CPI and core inflation. Core CPI is just kind of a way to get familiar. I would look at the jobs reports and the housing reports with less emphasis, but understand how they mix. But if you just get those four reports with an emphasis on GDP and inflation, you will have a much broader understanding of what the Fed is looking at and what they're talking about and that their press conferences and all the Fed has meetings and everything else, because they really reference all the inputs to this and they reference these numbers themselves. But if you just track those four, you will have a good understanding of the Fed's primary responsibility, right? So control monetary policy vis-a-vis jobs
Yep.
and by economic growth.
Yeah, and stabilize prices, right?
Yeah.
Exactly. So, and then the last thing also is, even if you get some of the data points that, and you don't necessarily agree with them because maybe regionally it doesn't make sense to you, or you know yourself and family members or friends that maybe have lost their jobs, and you're like, wait a minute, I know people that are working 2 jobs. How can the unemployment rate be what it is? And this all doesn't really make sense. All you really need to know is, okay, find out what the data is actually reporting. And even if you don't believe it, you got to understand that whatever that data is reporting, the Fed is going to act on that data. So you got to understand that what the Fed is aiming to get, what they're looking to get. And even if you don't buy it, look, that's just the game. So you can plan ahead that way.
Yeah. So everything we're going to talk about tonight is going to really be somewhat of a focus on the data we just talked about. And it's going to explain a little bit more detail about what the current landscape is and help you understand how these things are impacting the market today. And hopefully by the time you hear this, why the Fed made the decision that they did to hold rates.
Yeah, exactly. And on top of that, tomorrow's meeting they'll also give us the summary of economic projections for us to know what's going to happen the rest of the year, or what they predict will happen.
And I think that's going to be a big indicator. Saied alluded to that on the last show, but basically the summary of economic projections, one of the key things we're going to see there is, will there be 2 rate cuts still kind of phantom for the future projected?
3 rate cuts.
Will there be 2? Will there be 3?
Oh, yeah. Will there be 1? Will there be
none?
none?
Exactly. So what their perspective is on the need for potential rate cuts in the future will be very, 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 very followed closely. Okay, well, and just anecdotally, if you're here this long,